In March 2023, Silicon Valley Bank went from business as usual to dead in roughly 36 hours. Depositors pulled $42 billion in a single day through mobile apps and wired transfers. It became the second largest bank failure in U.S. history, faster than regulators could react. Most people shrugged it off as a freaking event, a weird California tech bank with a quirky client base. They were wrong. SVB wasn't an outlier. It was a stress test that exposed weaknesses shared by hundreds of regional banks across the U.S. And those same weak points are now lined up in front of something much bigger. A wall of $1.80 trillion in commercial real estate loans coming due in 2026. That's not a typo. $1.80 trillion, roughly the size of Canada's entire GDP. These loans were written in a different universe. Interest rates near 0%, offices 90% occupied, commercial real estate sold as the safest thing in the room. Since then, the floor has disappeared. Remote work has permanently rewired office demand. Buildings that were 90% full in 2019 now sit at 50% capacity. Companies that once leased 5 floors now keep 2 and trying to sublease the rest, if they can. But the debt on those buildings, still priced for the old world. Most of these loans were financed around 3%. Now refinancing is happening at 8 to 9%. The math is brutal. At 3%, a building barely covered its debt service. At 8%, cash flow disappears. Investors see it. That's why commercial property values in major markets have fallen 40 to 60%. So when those loans mature in 2026, owners face 3 options. Refinance at much higher rates on a building worth far less than the loan. Inject massive new capital to plug the value gap, walk away, and hand the keys to the bank. Option 3 is becoming increasingly common, not because owners are reckless, but because it's economically rational. In 2024, Brookfield Asset Management, one of the world's largest, most sophisticated real estate investors, defaulted onto Los Angeles office towers. Not because Brookfield was going under, but because those towers were worth less than their mortgages. Paying full debt service on negative equity assets made no sense. So they stopped. That's already happening across America in isolated pockets. The difference is that in 2026, it won't be isolated. It will be synchronized. From real estate problems to systemic banking crises. Here's where it jumps from property story to full-blown banking event. Most of this commercial real estate debt isn't sitting at JP Morgan or Bank of America. It's concentrated in regional banks. For the big banks, CRE is a side dish. For regional banks, it's the main course. For many regionals, CRE loans are 20 to 30 minus 40% of their entire loan book. Federal Reserve data shows 1,800 plus banks with CRE exposure above 300% of total equity. Over 500 banks with CRE exposure above 500% of equity. These aren't tiny rural branches. Now imagine defaults rolling through in 2026. Loan losses eat into bank capital. Regulatory leverage ratios are breached. Banks fall below minimum capital requirements. At that point, regulators have 3 options. Step in, force a merger, or shut the bank down. And that's before we even talk about confidence. On paper, banking runs on capital ratios. In reality, it runs on trust. Once headlines showed multiple regional bank failures, depositors don't analyze balance sheets. They move. SVB showed us the template. A classic bank run compressed into 24 hours. Withdrawals faster than assets could be sold. Securities dumped at distressed prices. A liquidity problem turned into insolvency overnight. In 2026, the same dynamic hits hundreds of regionals at once, many with heavy CRE exposure. Some without realized losses yet, but the perception of risk will be enough. Result, deposit flight forces banks to sell assets at fire sale prices, creating the very insolvency people were afraid of. Insiders already see it. Barry Sternlicht, Starwood Capital, says regionals could fail every day or every week during the crisis. Howard Lutnick Newmark warns that every weekend another regional bank could go bye-bye, projecting 500 minus 1,000 bank failures in 2025 to 2026. These are core players in CRE and capital markets, not doomed accounts on Twitter. The FDIC and the limits of the safety net people assume FDIC insurance solves this. In reality, the FDIC insurance fund holds about $120 billion. Deposits at risk from rate-driven bank failure could be multiple times larger. That means emergency funding fights in Congress, political drama in the middle of a financial fire. Why do another 2008 may not be possible? In 2008, the U.S. government could credibly say, we'll backstop the system. Because federal debt was manageable, treasuries were the unquestioned risk-free assets. The government could borrow huge sums at low rates to fund TARPs, guarantees, and stimulus. Today, U.S. national debt exceeds 130% of GDP. That's higher than any time except World War II. Annual interest payments are approaching $1 trillion. The CBO projects that by 2026, interest costs will exceed defense spending. Debt service becomes one of the largest line items in the budget. At the same time, Treasury auctions are showing stress. Foreign buyers, especially central banks, are reducing Treasury holdings as they diversify away from dollar assets. So when the next crisis hits, Washington may not be able to borrow unlimited amounts at low rates to save everyone. The Treasury market itself is now a point of vulnerability. The Fed is trapped on policy. The Fed also has far less room than in previous crises. After more than a decade of near zero interest rates, massive QE, many easy tools are already used. In 2008, the Fed cut rates from 5% plus to 0%. To deliver equivalent shock power today, rates would have to go deeply negative, something the Fed has resisted. Buying more distressed assets or ramping emergency lending risks crystallizing losses and sparking political blowbacks. The Fed can still act, but it's operating under constraints that didn't exist in 2008. The dollar's role under pressure. For decades, the dollar's reserve currency status let the U.S. borrowed cheaply. Export inflation used the financial system as a geopolitical tool. Now that position is under challenge. China and Russia trade more in their own currencies. BRICS are building alternative rails. Central banks are buying record gold while cutting dollar reserves. Oil producers are accepting non-dollar payments. If confidence in U.S. financial stability is already fragile when the 2026 banking crisis hits, Treasuries may not behave as the unquestioned safe haven. To attract buyers, yields must rise. Higher yields mean higher interest costs. Higher costs mean less fiscal room to fight the crisis. That's the vicious cycle. The timeline is already on the calendar. This isn't crystal ball guessing. A lot of it is scheduled. $1.8 trillion in CRE loans maturing in 2026. $18 trillion in broader commercial debt also comes due that year. Banks know which loans are vulnerable. Regulators know which institutions are most exposed. Meanwhile, classic warning signs are flashing. The yield curve inversion that preceded the U.S. recession for 50 years is set to fully normalize by June 2026. Historically, that points to recession 12 to 18 months after normalization. That aligns with late 2025 to early 2026 as the recession window, exactly when the CRE maturity wave peaks. Consumer and credit data rhymes with that. Household debt has reached $184 trillion, a new high above pre-2008 levels. Population adjusted. Credit card delinquencies are rising among middle-income borrowers. Wealthy households keep spending. A bifurcated economy. Consumer spending is 70% of U.S. GDP. Small business lending has almost stopped as regionals tighten standards. Money supply has contracted sharply from pandemic highs. Commercial and industrial lending has stagnated. Historically, this kind of credit contraction leads recessions by 6 to 12 months. Added on, 2026 midterm elections right as stress peaks. Debt ceilings and budget battles, ugly optics of bailing out banks while households lose homes and jobs. And in the background, geopolitical flashpoints in Eastern Europe, the Middle East, and the Pacific. Any escalation during a fragile banking phase cooled turns a severe crisis into a perfect storm. The bottom line key numbers are guesses. $1.8 trillion in CRE loans maturing in 2026. $18 trillion in broader commercial debt maturing the same year. 1,800 plus banks with CRE exposure above 300% of equity. 500 plus banks above 500%. U.S. debt above 130% of GDP. Annual interest payments heading towards $1 trillion. The Fed sitting on $2 plus trillion in unrealized losses. The Fed can't simply print its way out. The Treasury can't just borrow its way out. The political system can't ignore its way out. What's coming is not just another recession. It's a restructuring of the American financial system. And most people still think it's business as usual.